Hi traders, you're welcome to my channel once again. I am OTJOSH, and in this video I want to look at some fundamentals about price itself so that we can start from the basis of price before we go further into explanation of other related terms. So this video I want to take you back to the basis so that from here you can start building your knowledge about price action and volume trading and trading in general. So basically in this video I want to show you the difference between price and price action and price sentiment, because most times we tend to confuse price for price action and price action for price sentiment. So I feel if you get to know the difference and the basics or the fundamentals, then from there you can build your knowledge to move on to make better decisions when you trade. Because if you understand what you're doing, price action trading no longer becomes as difficult or as confusing as it seems. The problem we're having is the confusion among these terms and doing one thing over and over again, calling it different names. So let's start. So on the very basic, the most fundamental part of trading is the price, and the price is formed by traders, right? But if you look at the exchanges, the New York Stock Exchange, the London Stock Exchange, you will realize that these are what we are banking on to trade. When we talk about the institutions, the big boys, the smart money, we bank on these people. These are the activities of these people are what we have to look for. They are what we have to wait for to make our own trading decisions. We, the screen-based traders. So for screen-based traders like us, the only way we can get to the market is through our computer screens and our monitors or our phones. But the real market is not in the computer screen. Excuse me. The real market is not in the monitor or not in the phone. The computer screen, and what have you, is just an interface of the real market. So if, for instance, we have this 200, 150 and 100, this is just to make it clear that these are significant points in the market. If you have someone put his fingers to grab this part of the chart and grab this other part of this chart and pull this chart back, it's as if this chart is covering the market. So we cannot see directly to the market, we can only see the activities, the footstep of the market. So therefore, what footsteps are we going to look at? We are going to look at the actions. We don't know the traders, we don't know their names, we don't know where they come from, but by their actions, by their volumes, we'll have an idea if this trader is an important trader with much volume, or if this trader is not as important, or if this trader is an emotional trader, if this set of traders are traders that trade based on just emotions or sentiment. We get to know those things from our charts, and these are what we can use to make our own decisions. So let's move on further so that we can see what's going to happen. Okay, so the next we're going to look at is how price is formed. So price is formed by buyers and sellers in the market. So in the market we have buyers, we have sellers here. When the buyers and sellers come together, we have what we call traders. So price is formed by traders, buyers and sellers. Okay, so when the buyers are buying and the sellers are selling, we now have what we call a market. When the buyers are buying and the sellers are selling, we have what we call a market. So let's move on. If the buyers now are buying X amount of value I don't want to give any specific number, but let's assume buyers are buying an X amount of value and sellers at the same time want to sell X amount of value. What do we have? We have a price. This is how price is really formed. When buyers are buying, if buyers wants to buy and sellers wants to sell, it is then and only then you have a price. So if buyers want to buy an X amount of gold or euro, pounds, anything, any commodity, any asset at all, we call it the bid price. And if sellers are willing to sell at that amount, we call it the offer. So this is basically how price is formed. Buyers are coming into the market. You see buyers coming into the market to buy. Let me show this. Okay, you see buyers are coming into the market and they want to buy. From here they want to buy, and sellers at the same time are ready to sell. You see sellers are ready to sell at the same time. So at the point where the buyers are buying, the action where the buyers are buying and where the sellers are selling, that action becomes price. And this is what we see at the left hand side of our screen. This action here becomes price. Here, this line here, it becomes the price. Sellers started selling from here, buyers bought, but now we have an agreement in value between buyers and sellers. Therefore, buyers agree that, okay, at this point I'm going to buy. Sellers agree that at this point I'm going to sell. And what is this? Value. This is a value, and this is value for us. This is confusion for them. Why? Because you can't have one person trying to buy at one point and someone else trying to sell at the other point, and the both of them cannot be right. One has to lose, and this losing game is what we on our screens are watching out for. When we see the part who lose or the part who win, we go and make our own decisions. So how profit is made? This is how profit is made. Now, based on traders' beliefs, buyers will buy low relative to where he can sell later. Then the buyers can make profits. And based on traders' beliefs as well, the sellers will say high relative to where he can buy later. So back to my previous illustration, you can see if buyers believe that if I'm buying from here, it's because I can sell higher. And if seller believe if I'm selling from here, it's because I can buy lower. This is where profit is made, not by them, but by us. They have their own belief. We have no belief. We can't believe in anything. Why can't we do that? Because we don't have the power. We don't have the cash flow. We don't have the money. The only thing we have is the information that they give us through their actions. So on one hand, when a group of traders believe that the price is going to go up and they can sell it later at a higher price, they buy. And at the same time, there are other groups of traders who is going to believe this price is high enough, so they will sell and they will expect to buy later. So when these two different beliefs comes together, value is being made and opportunity is being offered to us who trade from the screen. So therefore, when these things happen like this, we are going to watch out for the winner. Since we have no volume, we trade with $20,000, we trade with 10,000, 500, and 100, 50,000. That is as much as some of us trades. But these guys, they trade with millions of dollars. So they are the owner, they own the market. We only follow their footsteps. This is what price action is. And we follow their footsteps with the help of the trading charts on our computers. So therefore, when that happens, we need to see we need to see how this argument between buyers and sellers, not really argument, this agreement in value that will always lead to one winning and one losing. We need to know how they are being formed. But since we are not in the market, what these brokers have done, which is very good, is that they track price for us and they send us feedback. Among those feedbacks are what? Indicators. And the best of these indicators are what? The best of these indicators is the price and the volume indicators. You see, we have a bullish configured indicator, which we call bullish candlestick pattern, and we also have a bearish configured indicator, which we call the bearish candlestick pattern. Okay, now if we have an understanding of how price is formed, now how value is made, now we need to have an understanding of how we can know what visual indicator, what visual guide can we use to see these things happening, because we have now seen that price is clearly formed at the extreme of the charts. For instance, if this is the chart, you can see that we have open. Let me see, we have the open here, we have the open, we have the low, we have this where price opened, price moved up, and price closed here, and price made a high here. So if you look at this, you are going to see that this most significant part of this chart are here: the high, the close, the open, and the low. Why? Because at the edge of your screen, when the price opened, buyers and sellers made an agreement. So we can say that this is X. I don't want to put a name. This is X. They made an agreement. If at the price came down again from this point to this point, there was another coming together of buyers and sellers at this point. We'll call it Y. Then the price went up, and there was another coming together of buyers and sellers at this point. We call it A. And at this point again, there was another coming together of buyers and sellers, and we'll call it Z. You see, we'll call it Z. So this is what I'm trying to say. Now, at this point, we can't always see this thing with our naked eyes if this were just numbers. So what we have is an indicator. This indicator is called the price bar. It has a range of value where all the activities involving buyers and sellers happened, and the winner at the end of that activities. That means at this point, buyers and sellers came into the market, just like I have explained, and they found value at this low point. They made trade. The price went up. They found value again. They made trade. The price went up and up and up and up and up. They found value again. They made trade. It went down and it closed. When I say they found value, what do I mean? I mean that they agreed to trade at this point. At this point, buyers believed the price was very low to buy, and at this point, sellers also believed the price was high. But when they entered into the trade, sellers became the losers. It happened here again. Sellers believe, okay, this is high enough. Buyers still believe that this is low. They entered into the trade, and what happened? The price went up. So at this point, sellers were losing. Came up again. These sellers that were losing are still waiting here. Now they believed, okay, it's high enough now. Yeah, I think it's high enough now. So let me sell. And they sold. When they sold, buyers here already thought, okay, it's still low enough, I'll buy. So buyers bought here, sellers sold here, and the price came down and it closed. You understand? So with this indicator now, what do we believe in with price? We believe that there are buyers here and there are sellers here, but at the end of everything, the market is in the favors of the buyers, because we can see from the range that the buyers had more force to take this market up to this extent. This is what the price leading indicators, such the market leading indicators such as the price bar indicates. Not only the price bar, we have volume as well. But first, I want to cover just this part of the price action. So let's move on. So we have the same thing for the bearish configuration. The same explanation. At this point, buyers will always feel that they are right, so they will buy high. They bought, price went down, they were in a loss. Again, they did the same thing. They bought, price went down, they were in a loss. At this time, if they are to buy, that means they were to buy from someone who is willing to sell, which is the sellers. So at this 2-point, buyers were losing, sellers were winning. Sellers won to the extent that they drew the price down, and at this point, more sellers sold. The price came down, and at this point they even sold more because they've been seeing this strong movement, so they sold more at this point. But then buyers bought as well, and the price went up. So we can see that sellers came in strongly and took the price down, and buyers were able to take it up here. But the sentiment for this section, the sentiment for this day, the sentiment for this month, the sentiment for this 5 minutes, 1 minute, 10 minutes, 30 minutes, 1 hour, all time frame shows that the sentiment is bearish, is in the favor of sellers. Sellers are much more in control of the markets. So let's go on to the next. So after this, we can clearly now see the representation. You see the price sentiment, sellers here, buyers here, sellers here, buyers here. The same thing, different sentiment. The same action, different sentiment. Sellers lost here, sellers won here. Buyers won here and sellers lost here. The same price action but different price sentiment. Okay, so that is that. Now let's take a look at price action. Now we've talked about price sentiments now, right? So I think we should take a look at price action. Let's take a look at what are price action. What do they really mean? Now let's take a look at this. If you look at this price action, you see how clearly buyers won here. There is no sellers. The same thing here, buyers. The same thing here, sellers. The same thing here, buyers. But here we can see we have buyers and sellers. Although sellers are slightly in the market, they are slightly stronger because of the body of the sentiment of the candle is bearish. But you can see we have both buyers and we have both sellers. So this candlestick here, this price action here, has a significant interpretation, and each and every one of these price action have significant interpretation. Why am I bringing this up? Because with a sentiment like the previous one, with a sentiment like this, you can now rely on price actions like this. If you can understand this sentiment as this being sellers taking control of the market, you can now understand why price action like this can be used against with a sentiment like this. When you know sellers are in control, for instance, and you see a sentiment like this, let me see if I can do this. Okay, you see something like, okay, I can't do that here, but if you see a candlestick like this, you see it here. After the close of this candle, you see this candlestick going up and coming down to form a candlestick like this one here. Then you know clearly that the price will continue to go down. Why? Because there is a sentiment, and you saw the sentiment and you've seen an action. you see what other traders thought about the sentiment that you've just seen. So when you get this, you can go with your price. And this is how, basically, this is how trades are being made. But I'm not talking about strategies, I'm not talking about method to trade. I just want to give you a basic foundation of how these things are formed, so that you have an idea once we start doing more deep explanation videos. So after that, what do we have now? Let's go to sentiment, how sentiments are used to form trends. Now if you look at this chart, what we have here is a sentiment that has formed a higher low. So because of space, we can see that we have a low here. Price went up and came down and formed a higher low, and then broke this previous high, and it will continue to go up. Now how do we know that the market will continue to go up? Is after we've seen this sentiment, after we have understood the sentiment, that is when only that will price action have meaning. After the understanding of market sentiment, when you understand market sentiments first, then and only then will price action get meaning. So therefore, if price is at the 100 level here and it goes up to 150, it shows that the buyers are in control. If it comes down to, if it starts coming down yet could not reach the 100 level, it shows what? It shows that sellers came into the market, but they were not strong enough. And if it goes back up and break even the last point where sellers came in, it shows that yes, buyers are now in control and maybe even stronger than before. So when you get a sentiment like this, what happens? You now understand where a candlestick like this can stay. You can understand that this candlestick now is going to confirm this sentiment you've seen. This sentiment, not this candle, but this sentiment. So if you see a candlestick like this candlestick at this point, once again, oh sorry, I made a mistake. Okay, not this. If you see a candlestick like that at this point, once again, what you do is that you can now believe that at the 200 price level, trade will continue to go up, the market will continue to go up. And then you can use other of your methodologies like volume analysis to do whatever trades you want to do. So we'll go on to the next. The same thing is happening for a ranging sentiment. This is a ranging market, and at this ranging market, you can understand the sentiment here, whereby buyers took the market up, sellers brought it down, took the market up again, and sellers are bringing it down. So you understand the sentiment of the market in this form. And so we do it for a downtrend as well. This is the same, exactly the same thing. Sellers brought the market down, buyers took it up, couldn't take it more than the first point where sellers were coming from, and sellers broke the market down. Now you understand that sentiment is what is the accumulation of sentiments, different sentiments in the market form trends. So trend is not just a series of higher highs, higher lows. No, a trend is a persistent occurrence of market sentiment. When the market sentiment occurs again and again and again, you can just pause. You can just pause into your screen. You can just look at your screen, study your screen, and then you begin to see the sentiment playing out before your eyes. You just don't go and start making irrational decisions. So that is it. This is how the candlesticks, the price indicators such as candlesticks can be used to divide the market into two parts, which is the price sentiment, and from the price sentiment, from the observed price sentiment, we can go into the price. We can now start talking about the price action. So you need to observe the price sentiment first before you go into price action. So the summary is that the candlesticks are used only to understand the market sentiment and confirm that sentiment by using this visual aids called the price bar. You understand? That's what the candlestick can do. So the price itself is what's happening in the market. The bars are the representation of the actions. It is not the bars that are the actions, they are the representation of the actions. So let's go on before we round up. As you can see, okay, now you can see what's happening here. You see everything that I just said. You see it. These are the confirmations of all the sentiments that we need to. Now if you have a candlestick like this, now a sentiment like this, now you can see that this price, this 150 level, is a good place to sell, because we now understand that there was a sentiment, there was a persistent occurrence of sellers pushing this market down. So there is a greater chance of us selling, going with the sellers than going with the buyers. This is what it means. So at the end, our sentimental analysis is what allows us to categorize market into uptrends, ranging, and downtrends. Just our sentimental analysis helps us to do this, and our price action analysis helps us to take advantage of the sentiment that we have observed. Yes, this is what the reason, this is the difference between the price and the price sentiment and price action analysis means. So what I've been trying to make in this video is clear, that what we are doing as traders is looking at the action of people who have the power to move the market, and then using the price sentiment, the price actions, the visual representation of the actions of these people to make our own trading decisions. So without them, there is nothing. So in summary, I would like to keep this before I go. Buyers and sellers come together to form a market. We don't go with them. We have no way to form a market. We are just at our screens. We are looking at them. So their willingness to trade, forms value, which is price. If a seller is shouting and saying he has he has an offer and buyers are bidding, then they have value. The sellers think they are right, buyers think they are right. Okay, if you think you are right, go into the bet. If you think you are right, go into the bet. So they both go into the bet. So we are the observers. We are the people who are spying on what they are doing. So we cannot see these actions from our homes. No, we cannot. What we can see is the candlestick charts that help us to bridge the gap between the trading pits and the screen-based traders. So since we cannot see, this is what we use, the candlestick. We spy on them. And I want you to know that what you've been doing, why trading has been difficult, is that you mistake the bridge. You mistake these candlestick charts, these candlestick patterns, as the fundamental reality of the market. So therefore, the reason you act emotionally is if there is a market sentiment like this, and you see a price action like this. Let me say you see a price action like what will I use? Excuse me. Now, if there is a market sentiment like this, which is clearly showing that we have a downtrend, and then you see a price sentiment like this here, you see a price sentiment like this, what do? It's very simple. You start buying. If you see a price sentiment, let's say something like this, let's say you see a price sentiment like this, okay, this, I think, okay, yes, just like this. What you do, you say, oh, this is what I saw on YouTube. This is the hammer candle, and the hammer candle is found at the bottom of a trend, so I must buy. So when you buy here, what happens? The price goes up a bit and falls down, and you find yourself at a loss because you have forgotten the fundamental reality of trading. You have forgotten that the candlestick patterns are used only to bridge the gap between the trading pits and the screen-based traders. So whenever you open your chart in the morning, just know one thing, that you are being given an opportunity to see the action of the real traders. We are not the real traders. We only follow the actions of the real traders, and we make our own trading decisions. So traders, this is all I have for today. I hope this is going to give you a new mindset on how you should approach the market. In our next video, I would like to do the same thing for volume, because price and volume are the most important indicators, because they lead us. They are not lagging. They are the only leading indicators we have in the market. And after I've done that for volume, I will go into indicators, the lagging indicators, which are also very important. I've seen people saying they are not good, it's just price action, but if you want to be a professional trader, if you can and you can incorporate these indicators together, then you will make it big in the market. So this is what I have for today. I want you to like this video. If you've not liked, I want you to subscribe, because the channel is still a small channel and it's still growing. And if you have questions, you drop your questions in the comment section, and I'll do it to get back to you. So until next time, bye.